Understandably, property investors are always looking for the next best deal. And obviously it makes sense. You get a good deal, you give yourself the best opportunity of success to build a long-term profitable portfolio. Having said that, the easiest way to guarantee that your portfolio is not a success is to get something pretty wrong and have all of your money stuck in one investment. In this video, we're uncovering traps as well as looking at luxurious and cheap properties that could keep your whole portfolio stagnant for years. If you're new here, welcome. My name's James. I'm the co-founder and managing director of a property investment consultancy called Freighter Property Partners, but this channel is all about your education. If you like the video, don't forget to hit the like button and subscribe to the channel, but let's get into it. The first thing you need to avoid as a property investor investing in 2025 is buying a buy-to-let in London. Between the years 2009 and 2016, the property market in London was extremely strong and you saw really strong growth in that time frame. From 2016 onwards though, the growth in the London market has been very, very slow for a number of reasons. That first reason is affordability. The average couple on the average salary now in London cannot afford the average home, which means there's been a significant drop in demand for these types of properties. The property market is really a supply and demand issue. So when demand drops and demand for good quality homes drop in a certain area, in this case due to affordability, prices will then no longer grow in as much value because of that lack of demand. Essentially, because of the growth between 2008 and 2016, a significant amount of the market has been priced out of the market within London. This means that even with a dramatic increase in supply, the likelihood is prices are not going to do much in terms of growth moving forward. So if you're going to buy a buy-to-let in the current market in London, if you're just wanting to buy and hold that asset, you'll probably only get around a 3% yield in the London market, and you're not going to get any growth moving forward, which really makes it difficult to scale a long-term portfolio. The whole beauty of investing in property is you get the opportunity to make a rental profit as well as use leverage to build your wealth through the growth of the assets that you're purchasing. If there's no growth, whether you've leveraged or you've bought in cash, you're not building your wealth over time. And when you account inflation into that, your wealth is actually dropping over time because inflation is eating away at the value of that property year on year. This isn't to say that London is completely dead for a property investor in 2025, but it only really works for builders and property investors that are going to do big projects and completely transform properties. For example, if you're a developer that's really good at doing commercial to resi conversions, there's still going to be great opportunities in the London market. But if you're a property investor that wants to be hands-off, wants to focus on their day job or their business, and wants property to build their wealth in the long term, then London is not the market for you. You'd be much better investing in properties further north in the country, in places like Leeds, Manchester, Birmingham, Nottingham, in areas that are going to grow in value over time, rather than investing in your local market in London. This is the same for international investors. Whether you're based in Europe or further afield, it makes no sense to buy a buy-to-let in London unless you're planning on moving into it in the next few years. To be honest, I'd still argue I'm not sure if it's worth buying a property in London right now, even if you have the cash to do so. The second thing I would avoid as a property investor in 2025 is investing in single industry towns. These towns are often locations where you find the best yields because they've had a lack of capital growth in the last 5, 10 or even 15 years. What this means is you could be enticed by a 9, 10 or even 11% yield on a normal buy-to-let in this area, and it means that you're going to get a decent rental profit in the short term. Having said that, the reason you're going to get those yields is, like I mentioned, that property hasn't grown in any value in recent years. This again means that your investment is going to get worse over time because of things like inflation and the lack of the appreciation on the assets that you would be purchasing. An example of a town in which this might happen is somewhere like Blackpool. And this is absolutely no disrespect to anyone that's from Blackpool, it's just not one of the places that I would be investing my money in 2025. Blackpool's economy is almost entirely reliant on seasonal tourism and hospitality. This is essentially a low-wage, high-turnover industry, and when there's problems with the economy, the first thing people do is cut their holidays, which means there's instability for the local job market and means demand isn't there for local people buying local homes. And like I mentioned, when local demand drops, prices in that region don't grow in as much value, which means that although you've got a good yield on your property, that property is only going to stay in and around the value that you purchased it at, and essentially it's losing value over time in real terms. As well as that, if the economy does slow and people start to cut their holidays to places like Blackpool, this could mean that there's insecurity in relation to jobs. When there's insecurity in relation to jobs, people will struggle to pay their rent moving forward, which means you could have a property with either tenants not paying their rent or significant void periods where people aren't looking to move into the home that you've purchased. And bear in mind that one bad tenancy could wipe out a whole year's worth of profit and waste a lot of your time, energy, effort and money. Having said that, this isn't to say that all smaller towns are bad investments. There are some really good locations in smaller towns in which you could invest and give yourself the opportunity to get a good yield as well as have the opportunity for capital growth. But those locations are only going to be closer to big cities and big economic hubs where you're going to get the ripple effect of people moving to that location because they can no longer afford those other cities. An example of this might be Manchester, where people can't afford the more popular locations and starting to move into some more specific areas where they'll start to see that ripple effect, which means that the prices will grow in those local areas. Unfortunately for Blackpool, it's just too far away from somewhere like Manchester or Liverpool to really get that ripple effect, which means the prices are going to stay stagnant moving forward. The third and final investment that I would avoid like the plague as an investor in 2025 is so-called guaranteed rental schemes for normal buy-to-let properties. In the last 2 years, so-called government-backed rental opportunities have become more and more popular that promise to give investors 20 years of guaranteed rent and allow them to be completely hands-off property investors. And unfortunately, although it might sound really positive on the face of it, when you dive a little bit deeper, it's nowhere near as attractive as what it seems initially. The first thing you need to be aware of as an investor looking at this type of investment is the price of the properties. These properties are often positioned as cash-only property investments, which in my opinion is a red flag straight away. The reason they're positioned as cash-only investments is because lenders aren't willing to lend up to the value in which you need to be able to purchase this property. This essentially means that the property price is inflated because it has this contract with a housing association. Essentially, it means that you're paying too much for the property in order just to have this contract in place. This means that you're going to be tying up a significant pot of your own cash just to invest in this property on the basis that you'll get an 8% yield. In my opinion, it's definitely not worth tying away £100,000 or £150,000 just for this promise, especially because where these properties are located are usually in areas that have a significant lack of capital appreciation. So you don't have the opportunity to leverage, and you also don't have the opportunity to see these properties grow in value over time because of where they are and where they are in the country. Not only this, as the landlord, you then have to sign a contract with the housing association who write the contracts. They obviously write them in their best interest to protect themselves rather than to protect you. This means that if and when something does go wrong, you could have a vulnerable tenant in that property that you obviously can't kick out because of their personal situation that won't be able to give you any income. So you'll not only have 100 or 150, maybe even more money stuck into a property, but you're not going to get any return on that money at all. Having said that, there are some protections that you could have as a landlord. Obviously in the contracts they do say if there is reasonable damage, the housing association will cover that, but in my opinion, it's just not worth it. And I've heard story after story after story where properties are trashed and the housing association have just washed their hands of it and have essentially walked away from the property, leaving the landlord stuck with a property that's essentially been trashed and not getting a rental income. As a property investor, you always need to protect your risk at every stage. I understand with some people when they're investing in property, they also want to do good for society, so want to rent the property out to vulnerable people. And if that's the case for you, then absolutely fair enough. But what I would do instead is, rather than buying a property that's already got a contract in place with the housing association, you're better off buying a property and going to the local council and asking them if they have people that they want to put in them and agreeing that contract yourself. It's not super complex and it's relatively straightforward, and then at least from that perspective, you know you've bought the property at the right value, you've probably got lending on that property as a standard buy-to-let, and then if you want to rent it out in the way that you want to, then ultimately it's your property. You can do what you choose with that. Essentially, what you need to do as a property investor is question why someone would be offering you a guaranteed rent for this extended period of time. And the truth is, it's not really as straightforward as it seems, and it's not the best thing as an investor. Although they say they're government-backed contracts, you're getting into an agreement with a private institution, and these private institutions have gone bust in the past, which leaves people pretty stuck when they own a property or have a contract with one of these private institutions or housing associations. Again, it's your money, so essentially you can choose what you do with it. But if it was me, I'd go for a way simpler thing with a normal buy-to-let in an area primed for long-term growth and leverage that investment. So to recap, I'd avoid London as a buy-to-let investor because the market has been stagnant since 2016 and you're unlikely to get a good yield or any capital growth moving forward. I'd avoid economically fragile towns across the country where you're likely to get slightly stronger yields because of the risk involved and the lack of opportunity for capital growth moving forward. And finally, I would avoid so-called guaranteed rental schemes that give you a guaranteed rent for a 15, 20, 25-year period for a standard buy-to-let. The risk involved in these are significantly higher than most standard property investments, and in my opinion, it's just not worth it. Instead, focus on good quality properties in areas primed for long-term growth where there's still strong affordability for the local market. You need to target areas where demand is high and you can be confident on the long-term appreciation because of the improving overall fundamentals of that area. Like always, there's always going to be some sort of risk to investing in anything, whether that's property or something further afield, but you need to mitigate those risks at every stage to give yourself the best opportunity to build your wealth. And that's exactly what we do here at Freighter Property Partners. We only focus on good quality buy-to-lets in areas primed for long-term growth because it's the least risky way to invest in property. It's obviously not for everyone, but everyone can make their own mind up to which strategy is right for them. I'll put a link to our website, Freighter Property Partners, in the description, so feel free to click that link and get in touch if you just want a free conversation with one of the team. But that is it for today's video, so thanks again for watching, and I'll see you soon.